You know, as we enter 2026, there's something really important I want to share with you. I'm Salim Ramji. I'm the CEO of Vanguard, and we manage $9.3 trillion globally. That's more money than the entire GDP of most countries. And here's what I'm observing right now. Millions of investors are structuring their portfolios as if we're still living in the 1980s. 60% stocks, 40% bonds. The classic model, the safe model. The model everyone's been taught for decades. But here's the thing. This model was severely tested in 2022. Both stocks fell and bonds fell, together, at the same time. That wasn't supposed to happen, right? Bonds were supposed to provide protection. But they didn't, because the world changed. The economy changed. Inflation came back unexpectedly. The interest rate environment shifted completely. Today, I'm going to share with you 4 asset categories that professional investors typically consider. These aren't definitive recommendations. They're areas that each investor should evaluate based on their own situation. But these are the trends we've been observing at Vanguard for 50 years. Let's dive in. All right, let's talk about the first asset category, Treasury Inflation-Protected Securities, TIPS. But Salim, you might say, bonds are boring. The returns are low. I want growth. I understand. Most young investors think that way. But let me ask you something. Have you tracked how much inflation has increased since 2020? In America, inflation was 1.2% in 2020. Then it jumped to 7%. Then to 9%. If a significant portion of your portfolio was in fixed income instruments during that period, your purchasing power may have declined substantially. You see the same number in your account nominally, but in real terms, you can buy much less with that same amount. This is where TIPS come in. TIPS are inflation-indexed bonds. When inflation rises, the principal value of the bond adjusts proportionally upward. You receive interest income, and your principal maintains its purchasing power against inflation. So why might this matter in 2026? Because inflation risk remains on the agenda. Central banks are adjusting their policies. Governments continue to borrow. Energy markets are volatile. Supply chains are still fragile. And in retirement, one of the most significant risks is the erosion of purchasing power over time. Think about it. You have a 30-year retirement period. In year 1, you live comfortably on $50,000 annually. But 30 years later, you'll probably need significantly more to maintain that same standard of living. If your portfolio isn't prepared for this, your standard of living could gradually decline each year. TIPS can serve as a buffer against this scenario. At Vanguard, we observe that many retirement portfolios allocate a meaningful portion to TIPS, often around 20 to 30% of the portfolio. But of course, this percentage can vary based on an individual's risk tolerance, age, and financial situation. This is based on the idea of protecting the portion that covers your essential expenses: food, housing, healthcare. These tend to increase with inflation. So some investors prefer to hold assets that potentially grow with inflation as well. Are TIPS boring? Yes. Are the returns low? Yes, typically around 2 to 3% real return. But they're considered a tool against inflation risk. So that's the first category, TIPS, potential inflation protection. But let me emphasize again, this may not be suitable for everyone. Young, aggressive investors might make different choices. Now let's move to the second category, and this is my passion. Vanguard's DNA, low-cost index funds. Look, I spent 16 years at McKinsey. I did strategy consulting. I advised some of the world's largest companies. Then I moved to BlackRock. I stayed there for 10 years. I ran iShares. I worked alongside Larry Fink. And what can I tell you? Over the long term, many active managers tend to underperform the index. This isn't an opinion. This is an observation supported by academic research. Track the S&P 500 over 10 to 15 years, then track most active fund managers. Research shows that 80 to 90% of them underperform the index over the long term. Why? One fundamental reason: high fees. Some active funds charge 1%, 1.5%, sometimes 2% annual management fees. Let's say the market returns 7%, but you're paying 1.5% in fees. You're left with 5.5%. Whereas an index fund can offer you similar market performance for a very low fee, like 0.03 to 0.05%. Over 30 years, this fee difference can create very significant differences in your portfolio size. Vanguard's founder, John Bogle, created the first index fund in 1975. Since then, our mission has been provide low-cost, broadly diversified investment vehicles. Many long-term investors hold a significant portion of their portfolio, sometimes 40 to 50%, in low-cost index funds. But I'll say it again, this may not be the right allocation for everyone. Both U.S. markets, S&P 500, total stock market, and international markets, developed countries, emerging markets. Because economic growth doesn't happen in just one region. India is growing. Southeast Asia is growing. Some emerging economies are developing rapidly. If you invest in only one region, you might miss potential opportunities in other regions. And please be careful. Individual stock selection is very difficult. Yes, some companies have shown extraordinary performance, but for every successful stock, there are many that fail. Most individual investors struggle with picking the right stocks, timing the market, and controlling their emotions. That's why many experts recommend index funds. You own a broad market basket. Whichever companies succeed, your portfolio benefits from them to some degree. So that's the second category: low-cost index funds, potential growth engine. But remember, past performance does not guarantee future returns. The third category is an area that doesn't get enough attention in many individual portfolios: real estate investment trusts, REITs. Now pay attention. Real estate doesn't mean you must buy a house. Buying a house is a completely different decision. The real estate market is local, liquidity is low, there's personal use involved. I'm talking about something else: institutional scale real estate investment. What are REITs? These are companies that own and operate income-producing real estate like commercial buildings, shopping centers, data centers, logistics warehouses, healthcare facilities. They generate regular rental income from these assets, and in many countries, by law, they must distribute a large portion of this income to shareholders as dividends. So what could this potentially offer you? 1. Potential regular income. REITs typically yield 3 to 5% in dividends. This can create cash flow in retirement. 2. Potential inflation protection. During inflationary periods, rents tend to increase. Real estate values can also rise, so both income and asset value can move in parallel with inflation. 3. Portfolio diversification. Real estate historically shows different correlation patterns with stocks and bonds, so when the stock market declines, real estate might behave differently. When I was at McKinsey, we analyzed the portfolio structures of institutional pension funds. Many institutional funds allocate 10 to 15% of their portfolios to real estate assets. Individual investors generally much less, sometimes nothing at all. This could be a potential missed opportunity, especially in this period, because right now, demand for data centers is growing rapidly. Artificial intelligence, cloud computing, digital infrastructure, all of these require data centers. And REITs that own data centers have shown attractive performance recently. Similarly, logistics warehouses. As e-commerce grows, major companies need more storage space. So how can you access this? It's quite simple. REIT index funds are available. You buy one fund, and you gain indirect exposure to hundreds of real estate assets. Most institutional investors allocate 10 to 15% of their portfolios to real estate assets. For individual investors, this percentage can vary based on personal goals and risk tolerance. So that's the third category, REITs. Potential income source and inflation protection. 1. Illiquidity premium. You sell a stock on the exchange. You get cash immediately. In private markets, it's different. You might need to wait 5 to 10 years. But this liquidity constraint, theoretically, can provide additional return potential. 2. Potential inflation protection. Infrastructure assets, energy grids, ports, typically have inflation-indexed revenue streams. 3. Different volatility profile. The stock market is priced daily, going up and down. Private market assets aren't priced daily. This can appear more stable on paper. When I was at BlackRock, we acquired Global Infrastructure Partners for $12.5 billion. Why? Because we believed infrastructure investments would be an important investment area for the future. As Vanguard, we're working to offer private market products in 2026. We're planning to add private assets to our target date funds. This way, an ordinary worker could gain indirect access to such assets through their retirement account. So, what can you do? If you have access to appropriate vehicles and your risk profile is suitable, you might consider allocating a portion of your portfolio. Some experts suggest 10 to 20% to private markets. If access isn't available yet, this area is expected to open up more to individual investors in 2026. So that's the fourth category, private markets, potentially differentiated growth area. But caution, these assets are illiquid, can be risky, and aren't suitable for everyone. All right, let me summarize everything. As we enter 2026, here are 4 asset categories that professional investors typically consider. 1. Tips: Treasury inflation-protected securities. In institutional portfolios, typically around 20 to 30%. Buffer against inflation risk. 2. Low-cost index funds. In many portfolios, around 40 to 50%. Long-term growth potential. 3. REITs, real estate investment trusts. In institutional portfolios, around 10 to 15%. Income and diversification potential. 4. Private markets. In institutional portfolios, around 10 to 20%. Differentiated return potential. Are these boring? Yes, somewhat. Will they make you rich quickly? No. But they can be part of a long-term, disciplined approach. I'm Salim Ramji. I was the child of an immigrant family from Tanzania. Today, I lead the world's second-largest asset management firm. But let me be very clear with you. What I've shared in this video are not definitive recommendations. These are general trends we've observed through 50 years of industry experience. Every investor's situation is different. Your age, income level, risk tolerance, financial goals, all are different. That's why before making any investment decision, please consult with a licensed financial advisor. Review your portfolio today. Do these 4 categories exist? Are they appropriate for your situation? Ask an expert. Let 2026 be a year of informed decisions. Best of luck. One final reminder. Nothing I've discussed in this video constitutes personalized financial advice. Investment decisions vary based on an individual's age, risk tolerance, financial goals, and circumstances. Please seek professional guidance before investing. Past performance does not guarantee future returns. This video is for educational purposes only.